Welcome to the Deep Dive. Today we're tackling that question that, well, seems to be on everyone's mind here in Austin. What is really going on with the real estate market? Is it still hot? Has it, crashed? Or is the truth maybe a bit more complicated than the headlines?
Yeah, it's a market that gets so much buzz, doesn't it? But often the actual story gets kind of lost.
Exactly. So that's what this deep dive is all about. We want to give you clarity. Our mission really is to deliver the clearest picture possible from the very latest data. We're looking at numbers right up to Wednesday, July 9th, 2025.
Right. We're aiming to distill what's actually happening on the ground. Cut through the noise.
Give you that shortcut to really understanding this dynamic market.
And right off the bat, the sources are pretty consistent. They paint a picture of stabilization. The Austin market seems to have found a new plateau.
Okay, a plateau. So not falling anymore.
Correct. Definitely no longer in that free fall mode we saw. But, and this is really important, it's not bouncing back either. Not rebounding. We're looking at something more like a drawn-out phase of market recalibration. Think slow adjustment, not a quick snapback.
Okay, drawn-out recalibration. So if the market's stable at this new level, what does that actually look like? Where should we start? Supply.
Yeah, supply is the big story here. Inventory. The main thing to grasp is that Austin's inventory is still at, historically high levels.
Okay.
Right now, we're seeing about 17,600 active residential listings, give or take.
17,600. Wow.
Yeah. Now, that is down just a little bit, maybe 400 units or so from a peak we hit just a couple of weeks back, end of June. That was over 18,000.
Right.
But the key takeaway, even at 17.6K, that figure is still among the highest levels Austin has ever recorded.
So tons of homes for sale.
Exactly. It's a fundamental shift.
And with that many homes, that must put pressure on sellers, right? What about price reductions? Are sellers adjusting?
Oh, absolutely. This is a critical indicator right now. Get this. 57.2% of all active listings have had at least one price drop.
More than half.
More than half. And in some areas, it's even higher. You look at places like, say, Georgetown, Liberty Hill, Pflugerville. They're seeing over 60%, sometimes closer to 62% of listings with price cuts.
Wow.
It's a really clear signal. Sellers are actively adjusting to, slower demand, the hope for those peak 2022 prices. It's definitely fading for many.
Okay, so massive supply, sellers dropping prices. That leads us straight to the other side of the coin, demand. How active are buyers, actually, when they have all this choice?
Yeah, buyer activity is definitely lagging considerably. We use something called the activity index. Basically, it tracks buyer engagement inquiries, showings, offers, that kind of thing.
Got it.
Right now, it's sitting at just 19.6%.
19.6, is that low?
It is. Compared to last year at this time, it was 23.2%. So that's a drop of over 15% year over year.
Okay.
And just for context, a healthy, balanced market, you'd typically want to see that activity index number above 30%.
30%, so 19 is quite a bit lower.
It really paints a picture of buyer hesitancy, or maybe just buyers taking their time.
Okay, that makes sense. What about months of inventory, MOI? Remind us quickly what that tells us.
Sure. MOI is basically asking, if no new homes came on the market, how long would it take to sell everything currently listed at the current pace of sales?
Right, a measure of market balance.
Exactly. It tells you who has the upper hand, buyers or sellers, and right now the MOI is 6.26 months.
6.26, how does that compare?
Well, last year it was 5.33 months. So we've seen a jump of over 17% in just 1 year.
17% increase in MOI.
Yeah. And what that unmistakably signals is that Austin has shifted. We've moved from what was maybe a neutral market into a soft buyer's market.
The buyer's market.
A soft one, yes, but definitely favoring buyers. And just to underscore that shift looking year over year, July 24 to July 25, MOI is up over 13%. But look at year to date, January 25 through now, it's jumped a massive 35.3%.
35%. Goodness, that really shows the change.
It really does. It's like, the power dynamic has flipped quite dramatically.
Okay. And I know another thing we're tracking is the gap between new listings coming on and homes actually going under contract pending sales. What's happening there?
Right. This gap really highlights the imbalance. So year to date, we've seen about 30,500 new listings hit the market.
Okay.
Now, that's actually down slightly, maybe 3% compared to last year, but it's still high historically, almost 16% above the long-term average. So lots of new inventory still flowing in. But the number of homes going under contract, the pending listings year to date, that's only around 23,600. That's down over 15% compared to last year, and it's actually about 7% below the long-term average for pending sales.
So wait, let me get this straight. Lots of new houses coming on, historically speaking.
Right.
But fewer houses actually selling than we'd normally expect.
Precisely. You can see it in the ratio.
Yeah.
The current monthly new listing to pending ratio is just 0.52.
0.52. What does that mean in plain English?
It basically means for every 2 homes that get listed for sale, only about 1 is actually going under contract that month.
Wow. Only 1 in 2.
Yeah. And historically, over the last 25 years, that average ratio is more like 0.81. So much closer to 1-to-1.
That's a huge difference. 0.81 versus 0.52.
It is. It shows far fewer homes finding buyers relative to the inflow. And that leads directly to that pileup of inventory we talked about. Cumulatively, just this year, that difference between new listings and pendings is almost 7,000 units.
7,000 extra houses, essentially, that the market hasn't absorbed.
Exactly. Excess inventory sitting there because buyer activity just isn't keeping pace.
Okay, so this paints a pretty clear picture. High inventory, hesitant buyers, sellers cutting prices, this growing pile of unsold homes. Which brings us naturally to the big question. What's all this doing to prices, and who is actually buying and selling in this market? Let's talk sales and value.
Right. So let's look at actual closed sales. From January through July, total sales were around 17,700 properties.
Okay. How does that compare?
It's down about 5.7% from the same period in 2024.
Down, but maybe not drastically.
Well, interestingly, it is still about 6.6% above the long-term average for sales volume.
Oh, so more sales than average, historically.
Yes. But, and this is crucial context our sources highlight, the Austin region has grown massively. Population growth, realtor growth.
Right, lots more people, lots more agents.
Exactly. So when you adjust today's sales volume for those dynamics, for that growth, it's actually relatively weak.
Ah, I see. So the raw number might look okay compared to history, but per person or per agent, it's lower.
Precisely. The market might be churning, but it's not particularly efficient at moving homes given how much bigger the potential pool of buyers and sellers is.
That's a really important nuance. So how much lower is it? Like sales per capita, sales per realtor?
Yeah, those density metrics are quite revealing. Cumulative sales per 100,000 people, down 8% year over year. And it's more than 21% below the long-term average. We're at about 694 units per 100K.
Okay, down 21% from the norm.
And even more stark, look at sales per 1,000 realtors. That's down just 1.6% year over year. But it's a full 25% below the long-term average, just 952 units per 1,000 agents.
25% below average. So the pie really has shrunk.
Significantly, especially for agents. It means, quite literally, more agents are chasing fewer deals than they have historically.
Okay, now the number everyone wants to know. Prices. Where are we now compared to that peak back in, what was it, May 2022?
May 2022, yeah, that was the absolute peak. So the current median sold price is sitting at $452,500.
$452,500. And the peak?
The peak median was $550,000.
Wow.
So that's a drop of 17.73%. Almost $98,000 off the median peak price.
Nearly $100,000. That's substantial. What about average price?
Average sold price is currently $596,400.
Oh.
Its peak in May 2022 was $681,939. So that's down 12.54%, or about $86,000.
So both median and average down significantly from the peak.
Definitely. And if you just look back 36 months, so 3 years ago, the median price now is still down over 12% compared to then.
Right. So these are sustained corrections, not just a blip.
Absolutely. Though there is a feeling in the data, perhaps, that the absolute steepest part of the decline might be behind us. Maybe.
Okay, a glimmer of stabilization there too. But what's really fascinating, you mentioned, is how this is playing out differently across the market. High end versus low end?
Yes, this bifurcation is really interesting. It's like Austin is becoming a two-tiered market.
How so?
Well, look at homes in the top 25th percentile by price. The higher end, year over year. Almost no change in price. Down just like 0.3%. Price per square foot, down less than 1%. Basically flat.
Flat at the top end?
Okay.
And the bottom?
Stark contrast. Homes in the bottom 25th percentile have seen pretty significant drops. Median price for that segment is down almost 5% year over year. Price per square foot also down nearly 5%.
Wow. So high end holding steady, low end taking the hits.
Exactly. A real split.
What does that tell us? What are the implications of this bifurcation?
Well, it certainly suggests a growing affordability gap. That's one thing. It also hints that demand is stronger, or maybe more resilient for those higher end properties.
Right.
That could be driven by, cash buyers, or maybe people moving with a lot of equity who aren't as bothered by current interest rates.
Less sensitive to the current pressures.
Exactly. It implies the entry-level market, the more price-sensitive buyers, they're the ones feeling the brunt of this correction, while the luxury or near-luxury segment is holding up relatively well.
And does this pattern hold across different areas too? You mentioned some cities seeing appreciation.
Yeah, it's uneven geographically, too.
Yeah.
We saw, I think it was 13 cities in the broader Austin area actually had year-over-year appreciation in their median sold price.
13 up.
Yep, but 17 cities saw declines. So again, it's not one single story across the whole metro. Very patchy.
Okay, fascinating. So high inventory, slow demand, prices down overall, but split between high and low end.
Oh.
Let's look at some overall market health metrics. What about the absorption rate? How quickly are homes actually selling relative to the inventory?
Right, the sold to active ratio or absorption rate, it basically tells you what percentage of the available homes actually sold in a given period. Currently, it's only 17.70%.
17.7. How does that compare historically?
Historically, the average is almost double that, closer to 32%.
32% average versus under 18 now.
Yeah. So this really low ratio, it just reinforces that picture of a sluggish market, one that definitely favors buyers right now.
Okay. And there's another metric, the market flow score, MFS. What is that at?
The MFS tries to capture the overall market efficiency or momentum, how quickly things are turning over, the general health. It's currently at 5.06.
5.06. Good. Bad. Average.
The historical average is 6.61.
Okay, so lower than average.
Right. Lower scores like this typically reflect a slower, supply-heavy market. Higher scores would indicate faster turnover, stronger demand, more momentum. So the MFS basically confirms everything else we're seeing. Things are moving more slowly.
Right. It all points in the same direction. So we've covered the now pretty thoroughly. What about the future? I mean, the big question for anyone who owns or wants to own, how long might it take for prices to get back to that 2022 peak?
Yeah, that's the crystal ball question, isn't it?
Yeah.
Our sources did run a projection using Austin's long-term, 25-year compound annual appreciation rate, which is historically around 5%.
Okay, 5% per year on average.
Right. So if you assume that today's median price, that $452,500 is the actual bottom.
The big if.
Huge if. But if that's the bottom and prices start appreciating again at that historical 5% rate, it would take about 50 months.
50 months, so just over 4 years.
Yeah, that would put us somewhere around August 2029 to get back to that May 2022 median peak of roughly $548,000.
August 2029, wow.
But again,
There's a catch.
there's a massive caveat. That entire projection relies on prices not falling any further from here.
Right.
And given the supply-demand imbalance we've just spent all this time talking about, well, you can't guarantee that yet. Further erosion is still possible.
Understood. So a potential timeline, but with a very large asterisk attached.
Exactly. A very large asterisk.
Okay, this has been an incredibly detailed look at the Austin market. Let's try and wrap this up for you, the listener. To recap, it seems the really sharp panic selling phase might be over. That's some relief.
Yes. The free fall seems to have stopped.
But the recovery, it's looking slow and definitely uneven across different price points and areas.
It's certainly not a rebound. Not yet, anyway. The market seems to be settling into this prolonged correction phase. Stabilizing, but at a lower level.
So what does that mean practically?
Well, for buyers, especially strategic ones who know what they want and where, this could actually be an opportunity. More choice, more negotiating power than we've seen in years.
Right. Patience might pay off.
For sellers, it's likely going to be more of a test of patience, adjusting expectations, being prepared for longer market times, navigating this new landscape.
Makes sense. Okay, so as you digest all this information, here's maybe one final thought to leave you with. We talked a lot about that bifurcation, the split between the high end holding steady and the lower end seeing declines. How might this prolonged correction, with that split baked into it, continue to reshape Austin? What could it mean long-term for affordability, for the kinds of houses being built and sold, for the very character of the city's housing market?
That's the big question looking forward, isn't it? How does this recalibration permanently alter the landscape? Something to watch.